E-mini S&Ps end the week on a rip higher, a new all-time high of 4,400, a new all-time close, all after that huge move lower to start the week out on fears of potentially another global lockdown and potentially slower economic growth, which is something that's been on the rise as well. So at this point, earlier in the week, it looked like things were going very much south for the equities, and then boom, we turn around, we see about a 4.5% push higher to end the week on a new all-time high. So clearly, stronger earnings have helped. Clearly, the growth numbers have helped. The inflation data, which is still there, remains quote-unquote transitory, according to the Fed, and that obviously has all been helping equities buoy higher here, despite the hiccup we saw earlier this week. Now, what does this mean for volatility? Well, if you look at the VIX index, we saw a move as high as 25 on that initial move lower on Monday. That's the highest we've been since mid-May, but it's been all downhill since then as equities turned around and started to rally. That correlation between volatility and the underlying indice continues to remain the same. Higher new all-time highs, lower volatility goes, and that's exactly what we saw. So volatility ends on near a 2-week low after that move higher to start the week after equities sold off. Lastly, what do we have next week? Well, we've got some growth numbers, we've got some inflation numbers, and we've got July FOMC. So looking at the growth side, GDP for the second quarter is expected to be about 8.5%. That's the good. Also, we're getting some of that PCE data, which is going to show inflation is on the rise near 6%. Likewise, we get the University of Michigan sentiment with its 1 and 5 year inflation expectations, which are also on the rise. That's the bad. So what is the Fed going to do, or what are they going to say at their FOMC meeting next week? Looks like Mr. Powell, who just spoke to Congress at his semi-annual testimony, will likely reiterate a lot of what he said. The Fed will continue to watch inflation and jobs and growth, with inflation remaining transitory, meaning that it is not here for a long period of time. It is merely here for what is looked like the reopening. The growth numbers look strong. How long will they be sustained? Are they going to be transitory as well, or will we see extended growth periods after the initial knee-jerk reaction? And lastly, the jobs numbers. The Fed is concerned with all the job openings and still seeing so many not applying for jobs. We see those jobs numbers come out each month. They look very strong. Sometimes they're not quite as strong as the market expects, but they are certainly strong job numbers. But now we're waiting to see what happens to those unfulfilled jobs. Why aren't they being filled? And the Fed likewise is going to have comments about that. Certainly the Fed has to be pleased with what we've seen with the recovery and the reopening. However, some of these inflation numbers obviously are going to start to be a thorn in their side as companies look to pass on some of those costs to consumers. That could slow down some of this growth. So a big week for equities, the fourth widest week of the year at about 180 points in the E-mini S&Ps, but next week we get some good in growth, some bad in inflation, and then the Fed to bring it all together for us.